In this lecture, we will explore the uncertain regulatory status of initial coin offerings, or ICOs. The key question for any ICO is, does it meet the SEC's definition of a security? If the answer is yes, then a whole slew of regulatory requirements kick in, and the purpose of the ICO, which is to raise startup funds at minimal cost, is defeated. But the SEC has yet to provide a bright line test that would allow market participants to know for certain if their proposed ICO would qualify as a security. However, the agency has left hints through various enforcement actions and public statements that market participants are relying on to structure ICOs in such a way that they think is exempt from security classification. But these market participants may be wrong and could one day find themselves on the other side of an SEC enforcement action that accuses them of violating U.S. securities laws. Thus, it is critical for any entity who is considering issuing an ICO to be aware of applicable securities laws and to think seriously about the potential consequences of violating these laws. So what then is a security? Well, for most of us, we think of things like stocks and bonds, which are clearly different from ICOs. But Section 2 of the Securities Act of 1933 provides a broad definition, which includes something known as an investment contract. Thus, the key question for determining whether or not an ICO is a security is, does the ICO qualify as an investment contract? The Securities Act did not establish clear guidelines for what constitutes an investment contract, which is why it ultimately fell to the Supreme Court in the 1946 case of SEC versus Howie to establish a test for determining whether or not certain transactions qualify as investment contracts. In what's become known as the Howie test, the court stated a transaction is an investment contract if it is an investment of money, there's an expectation of profits from the investment of money is in a common enterprise, any profit comes from the effort of a promoter or third party. If all four of these factors are met, the transaction is an investment contract, and therefore a security that needs to be registered with the SEC or qualify for an exemption from the registration requirements. But registering with the SEC takes time and is costly, and is obviously something ICO issuers want to avoid. The problem is that issuers can't know for certain if their ICO satisfies all four prongs of the Howie test in the eyes of the SEC. In July of 2017, the SEC provided some guidance on how they view ICOs when they released a report of investigation that looked at one specific ICO, known as a Decentralized Autonomous Organization, or DAO. Before I reveal their findings, let's take a moment to understand what the DAO was. The DAO was created by a group of people working for a company called Slockit, who wrote the smart contract that ran the DAO. Smart contracts are computer protocols that are intended to facilitate, verify, and enforce negotiation of a contract without the need for third parties. Between April 30th and May 28th of 2016, the DAO offered and sold approximately 1.15 billion digital tokens in exchange for a total of approximately 12 million Ether, which had a value of $150 million at the time. All of this was done on the Ethereum blockchain. After the funding period, the DAO began to operate, whereby various people made proposals to the DAO on how to spend the funds raised, and the members who bought the tokens voted to approve these proposals. If these proposals were profitable, DAO token holders were entitled to a proportional share of the reward. Now that you know about the DAO, do you think it satisfies the Howie test and is therefore a security? In their report of investigation, the SEC said yes. Let's take a look at their reasoning. First, the SEC determined that the DAO was an investment of money because it accepted the cryptocurrency Ether. The SEC has long held that cash is not the only form of contribution or investment that will create an investment contract. And in their DAO report, the SEC expanded the definition of money to include cryptocurrencies. Second, the SEC found that various promotional materials disseminated by Slockit and its co-founders clearly stated the DAO was a for-profit entity whose objective was to fund projects in exchange for a return on investment. Therefore, there was a clear expectation of profits by DAO investors. Third, the SEC deemed the DAO to be a common enterprise because multiple investors pooled funds into the DAO, and the profits of each investor were correlated with those of the other investors. And finally, the SEC found that any profit from the DAO was determined by the efforts of Slockit and its co-founders, and not the investors. Projects to be voted on by all DAO token holders were selected by a group of curators affiliated with Slockit. In addition, each individual token holder was anonymous and really didn't have much control over what the DAO did. Therefore, the DAO's investors relied on the managerial and entrepreneurial efforts of Slockit and its co-founders and the DAO's curators to manage the DAO and put forth project proposals that could generate profits for the DAO's investors. Although the SEC found that the DAO met all 4 factors of the Howie test and was therefore a security, the DAO never registered with the SEC because shortly after launching, the DAO was hacked and all the ether it had raised was stolen. Nonetheless, the SEC's report of investigation on the DAO, while not an official regulation, serves as a guidepost for all other ICO issuers to help them determine whether or not they need to register their ICO with the SEC. It may be possible that all ICOs qualify as securities. In fact, in February 2018, SEC Chairman Jay Clayton stated that every ICO he'd seen was a security. But until more formal SEC guidance is issued, ICO issuers must rely on the DAO report of investigation and SEC enforcement actions against other ICO issuers to help guide them. Based upon what we know, for an ICO not to be considered a security, it would require at a minimum a truly decentralized structure without curators, gatekeepers, and reliance on management, no profit intention, restrictions or significant controls on secondary trading. Token purchasers are given meaningful control over the voting, operation, promotion, and safekeeping of the enterprise, and token purchasers are provided all information necessary to make an informed decision. I should also note that some observers have begun to apply the Howie test to several cryptocurrencies, specifically Ether and XRP, and have argued that they also qualify as securities. This argument primarily hinges on whether or not these currencies are part of a common enterprise. Given that Ether was introduced by the Ethereum Foundation and XRP by Ripple Labs, and that both these entities continue to play a critical role in promoting their currency, a credible argument can be made that they meet the Howie test and are therefore securities. The SEC has yet to weigh in on this debate, but is apparently discussing the issue behind closed doors with other agencies. Any determination from regulators that Ether or XRP is a security could spark a wave of selling and rattle major trading venues. But for now, most cryptocurrencies continue to be considered a commodity by the CFTC. Because of the uncertainty that surrounds the security status of ICOs, a document has been developed by legal professionals in the cryptocurrency industry, known as the Simple Agreement for Future Token, or SAFT. If a developer believes that any token sold in the future will be a utility token, meaning they entitle the holder to specific services or units of services, a SAFT contract can be created as a security and sold to accredited investors. This contract ensures investors that tokens will be delivered to them once a functioning network or application has been developed, and tokens can be used on it. The bet that issuers and investors of a SAFT are making is that the SEC or the courts will determine that the tokens are not securities at this later point in time, while they might have been classified as such during the ICO because there was no fully functional network or no use value yet. Even though tokens issued using a SAFT are more likely to escape SEC security classification, the SEC has not officially confirmed that this two-step framework will work as intended. Outside of the report of investigation on the DAO, most of the SEC's involvement with ICOs has been through the enforcement process. In September of 2017, the SEC's Enforcement Division created a new cyber unit to focus the Enforcement Division's substantial cyber-related expertise on targeting cyber-related misconduct, including violations involving distributed ledger technology and initial coin offerings. In 2017, the SEC took 5 enforcement actions against cryptocurrency and initial coin offering firms. Thus far in 2018, they've taken 2 enforcement actions, with more sure to come. The SEC has also warned cryptocurrency exchanges that they risk operating illegally if they are selling securities and are not registered as a securities exchange with the SEC. Many of the websites where you can buy and sell cryptocurrency refer to themselves as exchanges, which can give the misimpression to investors that they are regulated or meet a regulatory standard of a national securities exchange. Platforms that decide to register with the SEC have at least 2 options: accept strict regulations that apply to public markets like the New York Stock Exchange, or lighter touch rules that cover alternative trading systems, which are private trading venues run by brokers such as Morgan Stanley. Registered exchanges have to enforce rules against fraud and manipulation and are prohibited from cutting deals that give certain customers advantages over others. Some of the best-known platforms for trading digital assets, including Coinbase's GDAX platform, limit their order books to only well-known cryptocurrencies like Bitcoin and Ether, which have been deemed commodities by the government. These platforms are effectively free from SEC oversight because they don't offer investments the SEC regulates. The SEC has also warned that platforms offering digital wallet services, which are used to safekeep digital assets, could run afoul of laws that apply to brokerage firms and other regulated entities that keep track of owners' securities.